Welcome investors. Shocking jobs report. Unemployment rate remains historically low. What is really going on with that U.S. employment rate data we got today? And does this number give the Fed the cover to raise interest rates one more time? Let's find out. But before we do, if you find value from this, be sure to like this video and subscribe to our channel so you can be ahead of the curve with our weekly videos. I'm Jake Ackerman, your investment advisor. Let's dive into it. All right, let's just put the jobs numbers right on your screen there and discuss those. Jobs report shock. American economy added a stunning 336,000 jobs in August. All right, I'm gonna level with you. August and September are seasonally high job number months. Everyone's done enjoying their summer. They're going back to work. They're slowing down on their travel, and kids are going back to school. So this is not out of the ordinary. We see this each and every year. It's the employment, people going back to work speeds up after the summer months. Let's do a deep breakdown and try to identify whether this employment rate is going to continue. Are we going to continue to see jobs numbers increase month over month? Do we really have a strong economy? Let's take a quick look, okay? What I have on your screen is a breakdown of the U.S. employment report we just got. So a total 336, which is in the thousands, 336,000. Let's look at the big ones. Education and health services. You see 70,000 there. All right, government, 73,000. And then leisure and hospitality, 96,000. All right, let's talk about each one of those. You have your education and health services. We're transitioning from summer to the fall where kids go back to school, elementary, middle school, high school, college. That means teachers are going back to work. We're going to see that number tick up due to that. On the healthcare side, we're really only going to see an uptick if we see a nasty flu season, a big COVID resurgence. Other than that, we'll probably stay flat in that area. Over to government, 73,000. I would expect that to continue. Government is going to continue to spend. They're fighting the Fed. They're doing the opposite of what the Fed wants. They're spending, they're hiring. We have an election next year. They're going to want to keep their employment numbers high. They're going to want to keep their spending high because their spending translates to GDP numbers. GDP numbers is what the economists use to say, if we have 2 negative quarters in a row of negative GDP, that's when we define a recession. So they're not going to want that to take place. So they're going to keep spending on infrastructure, spending on border wall barriers they're spending money on. They're spending money as much as they possibly can. So we probably will see that number continue. Now let's move on to the leisure and hospitality. What is going on there? Why are there so many new employees in that area? I think there's a couple reasons, right? So based on the San Francisco Fed, COVID stimulus has run out. There are no more savings with the COVID stimulus. There's limited saving now. We're seeing consumer spending on credit cards. We're seeing over $1 trillion of credit card debt. Delinquencies of credit cards are ticking up. That's not a sign of a healthy consumer. And another factor, student loan repayments just resumed. So these high spenders, the 18 to 44-year-olds, which are doing all the traveling, which are going to bars and restaurants, they're out of money. They're tapped out. They are putting money on the credit card, so they got to go back to work. And the leisure and hospitality field has been short of employees since COVID. They're glad to take them back. Will the spending continue because they're tapped out? I don't think so. So that will be determined. Well, I mean, we might have a couple more months because we're in this seasonal holiday. You know, people like to spend as much as they possibly can during this seasonality with the holidays. And these companies, these big corporations such as Amazon, are bringing back employees, trying to pay them more to get ready for the consumer spending wave, even though consumers are tapped out. So we really are not going to find out the full results of the consumer health until the first quarter of next year. Or, you know, we do get update reports during that, but we're not going to see what they're spending with. Are they spending with savings? Are they spending with increased in wages, which we just got a report today saying wages have not increased. They're not keeping up with inflation. So their purchasing power has been going down. That's why we're seeing credit card debt continue to pile on at a historic pace. So that's not a sign of a healthy consumer. So I would imagine this leisure and hospitality, new jobs are temporary, because I mean they're going to want to go back in because they can't afford their spending habits that they've developed over the last 3 years. Those are ingrained. The spending habits are ingrained. No one wants to downgrade their lifestyle. So they're going to tap themselves out with credit cards in any way they possibly can. And it's starting to show that they're tapped out. That's why we're seeing them go back to work, because they don't have any savings anymore. So the holiday time frame, yeah, they may continue to uptick as their student loan resume, but the rest of the folks who aren't in that 18 to 44 category are going to slow down their spending, and that's going to have ramifications. So that uptick in leisure and hospitality, I think, is just seasonal. Maybe we get 1 month data. Maybe we lead into that Santa Claus rally time frame, which is that November-December period. So that will be determined, and we'll keep you updated on that. So I want to talk about, the last thing I want to talk about here is that unemployment report remaining at a historic low. It's been accelerating on the downward path. Let me pull up on your screen here something that I showed you folks a few months back. So what you see here is the potential recession time frame chart. Up at the top here, you'll see this blue line, which is the 2 and 10-year inversion, which you see it before every recession, which is this magenta, what my mouse is on right here, that magenta color. Inversion, recession. Inversion, dot-com bubble, recession. Same 2008, 2009, recession. Here's where we're at today, highly inverted. Down at the bottom here, unemployment rate. Check it out. Accelerating on the decline. Recession. Accelerating on the decline. Recession. Same here, and same in 2006, 2007, and 2008. Accelerating unemployment. So we're seeing historic unemployment, and you're listening to the analysts go on TV, the consumer's healthy, yet they're spending on credit cards. Their delinquencies are rising on their credit cards. That doesn't sound very healthy to me. The unemployment is historically low. It's always low before a recession. It actually accelerates downward because people are flushing back to work. Savings is drying up. Consumers are becoming unhealthy, all prior to a recession. Probability for recession continues to increase as interest rates remain very tight. And will the Fed use this number, the seasonal number, as an excuse to raise rates at the end of October into November 1st? We still have a few more CPI reports. We still have a few more jobs numbers to analyze. And that's going to give us clear guidance if we get one more rate hike. The stock market says no. The debt market says yes. I like to lean towards the debt market, but things can change quickly if the consumer spending deteriorates, if the job number starts to loosen. Is this a one-off? These are questions that we're going to answer for you over the next month. So stay with us. Expertise you deserve, experience you can count on.